Welcome to this market intelligence briefing on the June 2026 divergence. A dove was expected, but a hawk has emerged. Let's look at the trade behind the tape. This analysis is built on our three-pillar framework: macro, fundamental, and technical. Remember, this is for educational purposes, not a recommendation to buy or sell. The easy money narrative cracked this week. With the new Fed chair, a hawkish dot plot, and clear market divergences, we are preparing for a potential pre-midterm sell-off. Section 1 covers the setup. A holiday-shortened week was met with a Fed surprise that has fundamentally reset the board. Despite a green close, the week was distinctly hawkish. Wednesday saw a sell-off following Fed comments, while Thursday's rally couldn't mask the underlying signal from the Fed. The market expected a dovish stance based on the nomination of Kevin Warsh. Instead, the tape delivered a hawkish press conference and a shift in forward guidance. Kevin Warsh has a long history of hawkish views, dating back to his time as a Fed governor during the financial crisis and his critique of quantitative easing. Bond desks are echoing the sentiment that Warsh is not the easy money chairman many anticipated. This gap between expectations and reality is driving volatility. In Section 2, we analyze the Fed pivot during the June 17th meeting, which effectively erased expectations for a 2026 rate cut. The message changed significantly. The median year-end projection rose, and nearly every official now anticipates a hike, with inflation risks tilted to the upside. The dot plot flip is the most critical chart. A move from an implied cut to an implied hike compresses valuations for tech and other growth-oriented assets. Fed funds futures are repricing rapidly, shifting from debating how many cuts will occur to pricing in a hike. This is a clear regime change. Warsh is also changing the operational landscape, removing standard forward guidance and launching task force reviews. This uncertainty acts as a valuation headwind. Section 3 examines historical patterns. Recent shifts in Fed leadership have consistently preceded significant equity drawdowns. History shows that transitions in Fed leadership often align with market instability. As we look at the current setup, the pattern appears to be rhyming once again. Looking at historical transitions, specifically 2018 and 2022, we see clear parallels. Both periods featured new leadership and immediate, significant market drawdowns in stocks and crypto. 2026 presents a nearly identical setup. With a new chair and hawkish signals, we are seeing early-stage divergences in Bitcoin and equities that suggest a major drawdown is the base case. Moving to Section 4, we look at the VIX signal. Volatility often whispers before it screams, and current patterns are indicating a shift in momentum. The VIX is currently signaling a potential down day. Historically, a VIX close down over 10% suggests an 85% chance of an S&P down day within 2 sessions. When we analyze VIX structure, we see an inside day back below the 50-period line, a broken bullish falling wedge, and a rolling MACD, all signaling potential volatility ahead. Divergences between the S&P and the S&P to VIX ratio have flagged major market tops for years. A larger divergence is currently building, indicating the rally may be nearing exhaustion. In Section 5, we break down the technicals. We are currently tracking 2 distinct Elliott Wave counts, yet both lead to the same destination. Our framework has successfully mapped the market path since early June, accurately calling the peak, the drop, and the recent bounce. Now, it is pointing toward the next major move. We are evaluating 2 scenarios for the S&P. One is bearish, where the current push is finished, and another is bullish, where a final 5th wave pushes to a new high before reversing. In the bear case, we have completed our 5-leg push and are currently seeing a lower high rebound. If this holds, we expect a crash in wave 3. The bull case suggests the recent pullback was simply wave 4. This implies one final push to a marginal new high, before divergence leads to the same broader sell-off. Key levels will confirm which path we are on. Breaking the June high invalidates the bear case, while losing the June low confirms the crash scenario. We are also watching open gaps in the S&P 500. Unlike the Nasdaq, these remain unfilled, providing a tactical argument for one final push higher in the bullish count. The Nasdaq is mirroring this technical setup. We are watching its momentum cloud and the June low as primary triggers to confirm the next directional trend. Zooming out to the weekly time frame, we see a multi-year rising wedge closing in. Losing the 50-week moving average could be the catalyst that opens the path to lower levels. In this next section, we examine the evidence stack. Divergences are appearing across multiple indicators and timeframes, signaling that the current rally may be losing its underlying strength. Looking at the widest lens, the monthly S&P chart shows a mega wedge pattern testing its apex. With the monthly candle down after the June peak, we are watching key trend lines and the 50-month moving average as potential magnets. Now let's move into the macro crossfire. We will analyze the interplay between oil prices, geopolitical developments, inflation, and Bitcoin, as these forces are currently loading the move. Crude oil is a vital inflation engine. Contrary to the narrative that the war is over, we are only seeing a ceasefire extension. Crude is testing its 200-period moving average. A bottom here could reignite inflationary pressure. Geopolitics remain volatile. The interim agreement regarding the Strait of Hormuz is not a permanent peace deal. Any return to escalation would likely trigger an energy spike, serving as a catalyst for a deeper market correction. Inflation is the Fed's primary trap. With May CPI at 4.2% and energy prices rising, the market is beginning to realize the Fed may be unable to cut rates as expected. This narrative shift is significant. Bitcoin has already begun to decouple from equities. Historically, Bitcoin often leads the broader market into bear territory. If this pattern holds, the equity market may soon follow it into a secondary leg lower. The catalyst chain is clear. Oil bottoms, inflation runs hotter, the Fed is boxed in, and finally, long-duration assets sell off. Even if only parts of this chain trigger, it is enough to break market confidence. We move now to the final section, our playbook. We will define the key levels, scenarios, and the decisive lines that will confirm our market outlook. These are the critical price levels that will determine the market's trajectory. Identifying where decisions are made allows us to trade with a defined risk-to-reward bias. Whether the market takes the bullish path for one final high or moves directly into a bear scenario, both roads lead to the same destination, a significant summer drawdown heading into the midterms. Here we visualize the bull versus bear setup side by side, allowing us to maintain a flexible stance while preparing for our base case outcome. Our conviction remains. We anticipate a sharp summer sell-off. The market often requires a reality check before the Fed will be forced to act. We are trading toward this sequence. This call is built on our three-pillar framework: macro trends, fundamental economic data, and technical price structure. It is the confluence of these factors that provides our trading edge. Thank you for watching this intelligence briefing. To stay aligned with the tape, follow us on our channels linked here. Stay disciplined and keep trading smart.